And so we believe very, very firmly that anyone can be an entrepreneur.
If you just bought and held the top 10 stocks from today and you held them for 10 years, I guarantee you'd more than double your money in the 10 years.
Wow.
Hello, welcome to another Wealth Within update. I am Jim Beach of School for Startups Radio, and joining me, as always, is Dale Gillham of wealthwithin.us. Dale, how are you doing this week? Good to see you.
Yeah, I'm fantastic in the COVID capital of Australia, but we're still staying fit and healthy. We're, as I said, in the nice country area, but I'm going for some walks along the river to get my fresh air, but getting a little bit of cabin fever, but we're okay.
We're definitely getting cabin fever here too, so I can relate to that. All right, let's talk about the market. We were a little bit pessimistic last week. We both think there is some irrational exuberance going on, and the market just goes up and up and up and up anyway. What did you see last week?
Yeah, the market was it was still indecisive. I mean, the Dow was only up 2.29%, but it was up one day, down the next, up one day, down the next. So that really is indecisive. The S&P wasn't up quite as strong. It was only up 1.25, and that's mainly because I think some of the tech stocks didn't push through. But the NASDAQ comp was down 1%. Again, you know, this could be the sign that the tech sort of boom is starting to go, but then 1 or 2 days or a week doesn't necessarily mean too much into it. But it'd be interesting to see what happens with the NASDAQ over the coming weeks. But we are seeing what they call intermarket divergence within the US market, because the NASDAQ's been at new all-time highs, you know, whereas the Dow and the S&P aren't. I mean, you know, we're also seeing divergence internationally as the NASDAQ, you know, is up 21.9% for the year. The Shanghai Composite's up 5.38% for the year, whilst all other major markets are in negative territory this calendar year. You're looking at Singapore's down 18.75%. The UK FTSE's down 16, the French CAC is down 15, the Hong Kong Index or the Hang Seng is down 11%, our Aussie All Ords is down just under 10, 9.67%, the Nikkei for Japan is down 4, the DAX is down 2.49 in Germany. So we're seeing this sort of international market divergence. You know, we've got couple of markets going up and the rest are going down, and so not necessarily a good sign. So why are those two markets going up so strongly? Why is the NASDAQ going up strongly, and why is the Shanghai going up really, really strongly? Because eventually they'll all come back together again. So what's been going down will come up, and what's been going up will come down. That's generally the idea of it. But that's a little bit of a worrying sign. But as I said, to me, a little bit more worrying or a little bit more concerning is looking at the tech stocks and seeing whether this stellar rise that they've been on over the past 12 months or more can be sustainable into the next 6 months or in the next couple of years. Well,
Dale, explain a little more. What could the intermarket or the international divergence really be a signal of? What does that mean long-term or even short-term?
Well, part of it is, I think there's a lot of talk around, you know, the US keeps printing money, and it does. You know, the Fed just keeps printing money to support the market. But as you and I have talked about, the fundamentals really aren't supporting that at this point in time. And we're seeing huge multiples there of price for whatever they're earning, and way above where they should be. So that suggests the rest of the world's being a little bit more sensible about it, and the US market's not being as sensible. They're just pushing the market because, you know, obviously Trump wants to win an election. If the market's going up, people are happier, people are making money, so he's more likely to get elected. So that could be part of it. But again, it's, you know, when you're getting other markets not performing very, very, very well, it gets down to monetary policy, because when you're looking at big institutions and countries, they all invest in each other. So right now the money's been going into the US to support the US market, but eventually it'll turn around, because, as I said, what goes up generally comes down, and what goes down goes up. So then you're going to get a switching of money through money markets and a whole range of other areas. You know, as I said, money will move into into stocks within other markets, and that's really what's likely to happen. So, again, it's sort of not necessarily a positive thing for the US market. I do think, you know, I do keep saying it. I do think there's issues around the US market, and I do think it's likely it's going to come down Hopefully it's not a big bang, rather than a gentle slowdown, which is a lot easier to handle, but time will tell.
Yes. Let's move on to another issue. You just alluded to it a little bit. The United States debt. Huge increases there. Of course, trillions of dollars of Corona spending, but it was already out of bounds. And before that, the Corona is just the icing on the debt cake. What numbers are you seeing there, and what do you think the implications could be?
Yeah, the US debt's just ballooned since the GFC. Obviously, Obama, with all the rescue packages there, the stimulus packages that happened, like debt basically doubled whilst Obama was in his presidency. And obviously, what we're seeing right now with the coronavirus crash and what's going on, there's a lot of, obviously, stimulus packages coming out at the moment. But according to the US federal debt clock, the US debt to GDP in 1960 was 52.65%. Now, I know you're sitting down at the moment, but in 2000 it was 57.13. So it didn't go up. So in 40 years, it only went up 5%. Now, it's currently sitting at 132.57%. So that's debt to GDP. So what are we making and what the debt do we have? Now, further, if you keep looking at that website, it actually suggests that the debt per US citizen is now $80,401 for each and every citizen, and for each taxpayer, again, sit down for this one, $213,276 for each and every taxpayer in the US, where just 4 years ago in 2016, it was only $60,000, so it's nearly gone up 400% in the last 4 years. So that's per citizen, and $171,000 per taxpayer. If I go back a little bit further, if you're looking at 2012, it was $49,285 per citizen, and $151,000 now per taxpayer. But again, it's, as I said, since Obama's, or since the GFC, we really do have had debt accelerating at increasingly faster levels. Now, to me, that means the US is heading for a cliff. It's going to be drowning in debt. It's already drowning in debt and keeps printing more money. But there is an economic theory. I don't know whether you've heard of modern money theory. It is a theory about, it happened when President, what was the one that got impeached? Not the
Clinton.
Watergate? No, not the one. Nixon. Sorry, I forgot his name. When Nixon uncoupled the dollar from the gold standard. So when he did that, that allowed what they call fiat currency, so they could just print more money. But there is a big push around economists around the world for this sort of thing, that you print more money when you're in dire times, you stimulate employment, all the et cetera, and effectively you can't go broke as a nation. So it is an interesting theory that I've been reading up about, and that's pretty much what the US has been doing, continually printing money to keep stimulating the economy. But again, you still got to think about it is, you can't, they're saying you can't treat it like a household budget. I know you and I can't keep spending money we don't have. It generally, something's going to hit the fan, but it just remains to be seen that what will happen with the US. But, at this point in time, I still think, the US really is heading for a cliff because it is drowning in debt. I mean, sometimes you've got to pay for it eventually, don't you?
You would think. And I agree. I would wish that they would run the country like the household and say we made $100 this year and we get to spend 95 or something like that. But, that's crazy thinking. All right. Earnings season. We've had a couple of early reporters. We have a whole wave this upcoming week. What's going on?
Yeah, well, like I mentioned last week, PepsiCo was the first cab off the rank, and its net sales were down like 3.1% for the second quarter due to the lockdowns, because just people weren't out. They weren't out going past the local convenience store, the 7-Eleven. They weren't at stores, restaurants, cafes, etc., buying Pepsi. So not necessarily surprising there. I know Coca-Cola does report this week, so I would expect the same for Coca-Cola. But interestingly, Netflix, obviously one of the stocks that have been driving the market, one of the FANG stocks, well, that missed analyst expectations on earnings per share. I mean, its earnings per share was $1.59 versus the analyst expectations of $1.81, and so guidance for their new
That's a big miss.
That's a huge miss, yeah. So they were expecting a hell of a lot more out of Netflix because people are home watching more Netflix, but you know, their guidance for new subscribers was less than half than what analysts expected. So, and the stock fell about 10% last week on that news. So, and that's why I'm saying we need to keep watching this tech space, because some of these big tech stocks may not be getting to what the analysts are expecting. Now, I know JP Morgan, their earnings exceeded expectations, and it was $1.04 per share. However, well, that was the expectation, was $1.04, but they came in at $1.38 due to really heavy trading revenue growth of 79%. So trading, and that was a lot of retail traders, as we talked a bit about yesterday as well, a lot of trading growth. But they've had to put aside about $8.9 billion for expected loan losses, and the outlook for banks in this corona environment and rising unemployment is that loan losses, they will get to levels not seen since the Great Depression. That's the expectation. So the banks are looking like they're going to be putting away money to cover all these loan losses, so they're fine with all of that. But again, finance and banking industry may not be that great an investment over the next 6 to 12 months. But we also saw Goldman Sachs beat their forecasts again, because it came in strong with the trading up as well. Bond trading was up 150% and equities up 46% during the second quarter. So some good news from the brokers, that sort of side of thing, with all that increased trading. But obviously on the financial index side or financial sector side with banks, etc., I think they're tightening their belts, and the next 6 to 12 months we'll see them. But I wouldn't expect a lot of growth out of those. But as I said just before, Coca-Cola is reporting this week, so is IBM, UBS, Tesla. I know you'll be keenly awaiting that. That's on Wednesday. Thursday we get Twitter, Intel, AT&T, and there's a whole plethora of other stocks reporting this week. So it should be a good one.
And Tesla, again, continues to go up on absolutely nothing. So do you think that one app that has been driving Tesla sales, so that for people who hadn't heard this story, apparently one app has been pushing Tesla and had 40,000 new purchasers, and that's been a part of the Tesla acceleration. Will eventually the SEC or somebody step in and do something about that? Is that situation something that should be going on?
Well, it's one of those things, and it's something that's repeated itself decade after decade after decade, because there's always a new flavour of the month. And the app you're talking about is Robinhood. It's an app that the millennials put on their phone, so the people under 30, 35 put on their phones. More of them are sort of under 30. They're in their early 20s. It sort of looks like a bit like a game, but they just pop up these recommendations in front of you, and there's a big green button. If you want to buy, hit it, type in an amount of money, and then you buy the stock. Now, it's commission-free trading. Now, I don't know about you, Jim, but I certainly don't work for free. And having something that says there's commission-free trading doesn't mean you're not paying for it, and you will be paying for it. If somebody's offering free brokerage, you are paying for it somewhere along the line, because the app providers and the brokers, they don't do this for the love or money or just because they're nice people. They're doing it to make money, so it does cost you. But where it's costing them is in hidden fees that they don't see, or spreads. But the apps, what they're doing is they're pushing up these recommendations with not really, in my view as an analyst, not really solid foundations into it. And then these people on the app talk with each other, and then they ramp up these stocks. So I'm buying Tesla, so you should too. And it's this whole herd mentality that comes about. And those 40,000 people from that one app, Robinhood, bought on one day. They didn't, that was one day. Right. And it was already running fairly hard from people on that app. That was just an example that I read in the New York Times article, I think it was. They just said in one day, 40,000 of them bought. Now, they're continually buying it. And eventually what happens when you got retail investors buying a stock, or the flavour of the month, and we saw that with Bitcoin. Everybody was buying Bitcoin. But eventually retail investors run out of money. They've borrowed everything they're going to borrow, and so they've been doing that for these apps. They've been borrowing using margin lending, they're borrowing using credit cards, they're borrowing any money they can to whack in these stocks that they're ramping. And not necessarily that's a negative way in terms of illegal, it's just that's what's happening. It's that herd mentality saying you've got to do this. We saw it back in the 1700s or 1500s with tulip mania. So it's the same sort of it's the same sort of mentality. It's that, oh, wow, this is going up, I've got to get in. It's the fear of missing out. But eventually these retail investors will run out of money. They won't be able to borrow anymore, and eventually it peaks and then it falls out of bed. And that's what will happen with Tesla. It will fall out of bed because, as we've already discussed, it doesn't make anywhere near as many cars as what Toyota do. But there are expectations around Tesla in the next 10 years having 25% of the car market with electric vehicles. So that's a pretty big, huge, tall order for them to have 25% of the car market now. But I have seen analyst expectations on that. So some of this rise you think could be justified based on that forward projection. But I don't think so, mate. I don't think
so either. They just can't build the factories that fast enough. They can't retrofit other factories fast enough for that. That assumes they take over a quarter of world production, and I don't see that happening.
And how many people do you know can afford a Tesla?
The people who already have them. Dale, and we know that a good chunk of those can't afford it either, right? I love the statistic that 2 out of 3 Americans that drive a Mercedes or a BMW had to lease it because they couldn't afford to buy it. So I just love that. Dale, what do you see for the upcoming week?
Look, I still think we're going to be, the next few weeks, I am expecting the US market to peak between now and probably the first week of August. So I'm expecting a high anytime soon. So I'm not going to discount it will go up a few more percent because it could be more into that 3rd or 4th week of July that will peak, possibly the first week of August. But then I think it will go down into September, October in a normal sort of market move. It may be a heavy move, but expect volatility, expect this one day up, one day down going, expect some bad news on different days on different stocks to push the market down and stocks around. So again, this right now to me is a wait and see or watch and see market rather than a jump in, but always be prepared to exit.
All right. Great advice as always. You can find out more about Dale and his team at wealthwithin.us, and we will be back next week with more great advice. Dale, thank you so much, and stay safe, you and all of Melbourne.
Thank you, Matt. Thanks very much, Jim. You take care as well.
And we will see you next week, everyone. Take care.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services licence, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Well, as I said with Jim, I thought last week the market was one day up, one day down, and I think we're probably going to see a little bit more of that this week, but I do expect it to continually drift up a little bit. But let's get stuck into the charts and see exactly what happened. So on your screen now, I've left it exactly the same as what you saw it last week. I've been mindful not to change it. Now, last week, as you can see here, the market, if I just expand that out, you can see it opened and it closed. It traded right up to this high here of 27.071 before coming down later in the week to close a bit lower on Friday, down at 26.671. Interestingly, we've seen the move up. It broke above last week's high. It's following that green line that I've actually drawn, so it might continue to keep doing that. Interesting, once we break this high here of 27.580, then I would expect the peak to be not too far past that. So we're getting close. Again, I do expect, as I said to Jim, that the peak will happen somewhere probably in that last week of July. It could already happen. This could be the peak, and we could see a turnaround and the market start to fall away down on this line. So don't discount just because it did go up like I thought it would, that it's not possible that it will go down again. We're in reporting season, so anything can happen, and this is probably one of the most eagerly anticipated reporting seasons since the GFC, definitely. But probably in a longer time than that. This second quarter is the first full quarter where we were in lockdowns. We had the coronavirus, and obviously the next quarter, now we're getting a second wave with coronavirus across different places across the US. We're getting shutdowns again, so the next quarter will also be interesting because obviously businesses would have had money to survive. The government stimulus is out there, but if the government keeps pushing out money, can it continue to push out the amount of money that needs to hold the economy where it is and keep working, or is it, are there things going to come off? Obviously, we know the $600 are going to come off unemployment at the end of this month, but is how much, what are they going to do, how are they going to do it? There's a lot of conjecture, but right now what my suggestion is just don't get into a lot of buying at the moment on the marketplace. This is really the time where you don't jump in, you just watch a little bit because it might spike up to that peak over the next 1 to 2 weeks, maybe 3 weeks, and then start to fall away. So you don't want to be buying into something, watch it rise up a little bit and then fall away and then having to be in a loss situation, which is really common with a lot of people. They tend to buy too late. And so if you're experiencing that, that means you're watching the market and you're following the herd on the market rather than making good decisions based on some good analysis. I'm not trying to be rude to anybody, I'm just saying you're actually following everybody, and when you follow everybody, you tend to buy in too late. So, but right now, where's the market going? As I said, I think it could go up this week, maybe next couple of weeks, maybe up right up to maybe, look, my estimate's probably up to around 28,000 points before it starts to fall away. But again, just be ready for the fall at any time. But let's now, we don't have any questions for this week, but what I'm actually going to do is cover some of the stocks that I mentioned to Jim in the report, for the ones that did report last week, but also going to cover some of the ones that are reporting this week and give you my thoughts on those. So let's do that right now. Okay, so Pepsi was the first one to get off the rank last week, as I mentioned to Jim. So let's go and have a look at that stock, and we'll give you my thoughts on it. Now, Pepsi, as it was down, their earnings were down a little bit, but you can see last week it jumped right up and then traded down a bit lower after the announcement. But it is looking okay. It really beautifully risen right up through to this high here in April after the March big fallout during the coronavirus. But people don't stop drinking Pepsi. Pepsi and Coke are one of those products that people just continually consume because even, as they say, when times get bad, people still do those things. They're the little pleasures that people still do. Like women tend to get their nails or their hair done even in economic uncertainty because it makes them feel better. And Pepsi and Coke, those sorts of products, people are generally addicted to them basically because of the sugar levels. But people, that's a nice little, how do I say, a nice little gift to yourself. People just buy a Pepsi or buy a Coke just to go, oh yeah, and you feel like you're okay if you've got one of those in your hand. And so to me, I think Pepsi's all right at this point in time. I don't think we're going to see too much more downside on that stock. I think it's more of an upside stock from here because you may even find people might buy more of it if they're buying more and stocking up for it to keep at their home. If they're at home working, they're going to drink more of it because you're not able to get out of the office and go and get a Pepsi at any time you like. Whereas if you're working from home, this looks pretty good. So this week, if its stock starts to move up and it breaks through this level here of 138.63, then I think that could be a good stock to own moving forward. Netflix was one of the other ones that reported, and then as you saw, it didn't. It was off analyst expectations, but you see here from the week before, it closed at 548, jumped right up to open at 567 and just reversed straight away. But you can see this big move. Really quick move right up into here. And this is what I was talking about a minute ago, is that's the angle that Pepsi normally runs on. If I use my trendline tool, you can see here, the angle's normally like that. But Pepsi's taken off like a rocket the last few, Netflix has taken off like a rocket, but it's when it does that, generally stocks will then only do that for a short period of time before falling away. So right now, I think Netflix is not necessarily one to buy. I think it's just coming back to its normal angle. So you might see it come back to 440, 420 into that sort of area. And if it starts finding some support there, it could be a buy moving forward. But right now, I don't think so. JP Morgan was another one we talked about in the report with Jim, who had reported last week. Again, it was a bearish stock from its high there back in January. It was falling away in February, then in March it fell away. Right now it's not looking super strong. It's in the financial sector. You can see here it hasn't risen anywhere near as much as Netflix or Pepsi since the March low. It's not. Whilst it did gap up last week, it's not strong. Again, so some of these financial stocks I'd be staying out of at this point in time, especially because we're obviously looking in the next 6 months to 12 months of mortgage defaults, and that will hurt the profitability of some of these companies that are doing that area. Getting on to some technology, we've got IBM here, which reports this week. IBM's interesting. You can see here long term, IBM, one of the biggest tech stocks, it's been falling since way back in 2013. And it's just like going downstairs. It just keeps going down and down and down and stepping down. And obviously there's your March low there at $90.53. Could this start to represent opportunity in this stock? And I think there's a good possibility there could be some good opportunity here. Yeah, it hasn't risen up since that February high. It hasn't risen up as much as Pepsi did. But it's looking okay. It's not falling away at the moment. It's a nice strong move last week. So my thinking is this looks good. So some of the money might be moving out of the big tech stocks that have had those stellar rises, and it might be moving into something a bit more sustainable. IBM's been around for a long time, and obviously they still sell lots of computers. They would have been selling a lot of computers during the coronavirus and products around, obviously, not just having the physical computer, but, it could be mice, keyboards, screens, you name it. They could be doing a whole lot of other stuff. So, be interesting to see what their report is, or the report comes out with this week. Last one I want to share with you is Intel. Again, Intel, I'm thinking it's not a FANG stock. It's not one of the ones they talk about as much, but you can see it's beautiful, strong rise at this point in time. If I use my trend line again, you can see that angle of it, and it's just moving quite nicely. It really has not had any euphoric buying. It did get hit pretty hard during the coronavirus from that January high all the way down, and it can move, and it's moved up nicely through here, popped back, found some support around that 56, and looking all right. I think this also could be another opportunity. So I think some of those FANG stocks that we've seen have been running really hard, and I think some of the money when it goes too hard, the money starts coming out of those. They take profits. The smart people start taking profits and putting into other stocks that they believe will start to rise. So Intel could be one of those. Have a look at some of the other chip manufacturers as well, not just Intel. There's a few of them with Qualcomm and a few others that are out there. Have a look at those as well. So that would be my suggestion. But if you have questions for me, I'd love to answer your questions. If you've got US stocks that you'd like me to look at, as I said, or as I've said in prior videos, if you're Australian, don't put Australian stocks on this one, put it on the Australian report. But if you have US stocks you'd like me to look at, if you have questions on the market that you'd like me to answer, please, happy to answer those. So get your fingers on the keyboard and put into the chat box down below, and I'd love to hear your questions from that point of view. But really, as I said, we do like to see some questions through on this report. But if you do, as I said, please stick them below and I'll get to typing those out. Now remember that here on this channel we do these Monday market reports every single week. And we also do a live stream in Australia, and I'm thinking about doing one in the US quite soon. But we do our live stream in Australia every Tuesday night. You might like to look at it because it's quite educational. If you're in the US or other places around the world, it is a good, whilst we do talk about Australian stocks, we do a lot of education in that, and it can be very valuable to you. And I know I've had a lot of people from around the world commenting on that. I've had comments from people in Italy lately, UK, people in Canada, people in the US who have been watching it and enjoying the recording of that. Now, you may not be awake when we're doing it live, but you can also watch the recording every single week. It goes up, I think, Wednesday morning Australian time. So remember to hit the subscribe button now. Click the bell on the right of it so you know when we upload our videos, and you'll know when our Wealth Within Stock Market Live Stock Market Show goes to air. For now, I'm Dale Gillham. Goodbye, good luck, and good trading.